A crypto liquidity pool is just simply a very big collection or huge bucket full of coins that enables a trader to swap one coin in and therefore take another coin out. Obviously, it provides liquidity for the market, and traders pay fees for that liquidity when they trade and swap coins. The key difference in crypto, though, versus the traditional markets is that with crypto liquidity pools, we can actually add our own coins into the pool and earn trading fees from people that use our liquidity to swap those coins. In this video, I'm going to explain exactly what a liquidity pool is, how they work, and then how to actually go ahead and use them to earn extra income from traders on your own coins. You don't have to give up ownership of your coins, but you can earn fees for providing a service for other traders that they want to swap and trade those coins, and we can earn passive income directly from doing that. So then firstly, we have to understand what a liquidity pool is, and I'm going to show you that by showing you the difference between the two main types of liquidity pool. One is an order book, which I'm going to illustrate with Binance, and one is called a market maker, or in crypto, it's an automated market maker. I'm going to show you Uniswap, but there are others as well, for example, PancakeSwap, which we'll see throughout the video. So what I want to go through first is exactly what an order book style market is. And you can see that right here. This is Binance. So with an order book style, you have a buyer and you have a seller, and they come to the market and show their orders on the order book. You can see it right now live. This is the Ethereum market. And on the left-hand side, you can see the order book right here. It changes tick by tick. You can see everyone's orders. Everyone is showing their orders to you. So what I can see here is that this price, obviously the highest price right here, is 2940.32, and on the right hand side you have a size. This is the amount of Ethereum that people are wanting to buy. 27 Ethereum, 28 Ethereum, as you can see here. Everyone is showing their order. They're showing you the exact price they want to pay. They are showing you how much they want to buy. This can be a collection of orders, not just one person, and then the system works out what the actual value of that is. Above this, you can see the sellers right here, the people that want to sell their Ethereum. Obviously, this is trading in US dollar tether. They are showing you the price that they're willing to sell at and the amount at that price that is available to sell. This type of order book works extremely well for very liquid markets that have a ton of trade and very large volumes in terms of the way that they trade. So you have a buyer and a seller, as you can see down here, that show themselves and then match up at a certain point. The point that they match up at is right here in the middle. Obviously, you have all these buyers right here, as you can see. So 2861 is the best bid, and 2861.01 is the best offer. So you have sellers on the top, buyers on the bottom. When that price actually meets, that's when a trade goes through, and that is when you trade. Now, the downside of this is that who's making money here from all of this trading and the trading fees that you pay? Well, it's these guys. This centralized company takes all of our trading fees. I pay trading fees when I buy, and the seller is also paying trading fees to Binance. So Binance are taking fees from both of us simply for providing a venue, a liquidity venue, because that's where the liquidity is. Here is where all of the traders are. And so we're paying Binance for running this business. Now we have to get on to what a market maker is, or in crypto, an automated market maker. This is a different way of trading and a different way of getting price discovery. When you want to trade, you need to know what price that you're actually going to trade at. So when I was trading stocks, I dealt with market makers all the time. I actually dealt with actual people who made markets, but they had a book and they were a market maker who made prices, both buy and sell. With the crypto, obviously it is all automated, therefore automated market maker. But you can have a system like Uniswap, as we can see here, that makes prices. And so if we want to sell Ethereum, we can actually get a price for that, US dollars right here, 2,940.2. But as you can see, there's no orders. I can't see the liquidity. It's just giving me a price. So how does it kind of get this price? Well, what actually happens is there is a huge bucket or a liquidity pool of assets. And in the pool, these two tokens have a ratio. The ratio is the price. So instead of having a buyer and a seller meet up and show all of their orders, what you have is a buyer right here who gets given a price because the pool is telling him exactly what that is, as you can see here. And the pool works this out via, some supply and demand characteristics. So when the pool sees that there are around $2,940 per one Ethereum, now obviously that's a ratio, so there could be millions of dollars in here and a ratio of Ethereum, but that is the ratio. There are $2,940 per one Ethereum in the liquidity pool, and so that is the price that I swap at. So I go to the pool as a buyer, and it tells me that if I want to buy one ETH, I have to put into the pool $2,940, and then out I get my Ethereum. Now the key difference here is that I have not matched up with a seller of Ethereum instantly, like on an order book. These coins are just sitting there 24/7 in that ratio, giving me that price. That enables me to trade any time of day and also get a price for cryptos that potentially don't have as much volume. Order books are great for high volume, high turnover markets. Market makers are great for lower turnover, smaller volume, and cryptos that don't trade as often. You can't show orders on an order book for a very illiquid crypto because you can really, crazily change the market. So for a very basic level, there's a ratio of coins and you just swap them in and out, and you don't need to match with a seller instantly. The coins are just waiting there for you to do that. There are pros and cons of each type of liquidity pool, but specifically with Uniswap or other AMMs, the key benefit is that we can provide our coins to those pools and then earn trading fees from traders. So this is how it works. You have a liquidity provider. That could be me, myself. And what I do is I deposit my tokens into the pool in a specific ratio, because they have to have a ratio that therefore have a price, one versus the other. You can see what happens here is that you have two tokens, so token A and token B in that ratio. You then get something called an LP token, which it's essentially a receipt to tell you how much of the pool that you actually own, which is obviously important if you want to take your assets back out again, or your receipt tells you how much of the fees paid that you actually are entitled to. So you get those LP tokens into your wallet. Now, from a trader's point of view, when they come on, what they do is they see the ratio of the coins, they get a price, and then they swap one for the other, and they get that in a ratio. And of course, they pay this fee, 0.03%. That fee obviously goes to us because we are providing liquidity. The way that an automated market maker has price discovery, unlike on an order book, is to change the price based on each trade. So the price obviously has to change dependent on the supply and demand of the coins in the pool. So what you can see here, when a trader trades, they put two tokens in a ratio and pay their fee. But what happens is the ratio of one of the coins is going to, well, both of the coins is going to change because there's a supply and demand difference. So what you can see here is that there's actually a protocol that takes place that tries to change the price a little bit dependent on the supply and demand of the tokens in that pool. So obviously, if one of the tokens is getting bought and becomes scarcer within the pool, that means that that asset becomes more expensive compared to the other coins, right? There are more of the other coin in the pool, less of this coin, and so the price goes up little by little, and there's a protocol that dictates this. So each trade in the AMM pool changes the price slightly, which is obviously needed because of the supply and demand. Traders pay 0.3% when they swap, but the trading fees go to the people that provide their assets in the pool and not the venue itself. In fact, the venue may take around 10% of the actual trading fee in reality, but most of it actually goes to the people providing their tokens as liquidity. To show you how a liquidity pool works in practice, we can go over to Uniswap and see all of the most active pools. So you can see the amount of volume or value that's locked in all of the pools. It's obviously going up quite significantly. If we come down here, what you can see is the most active pools. So the number one on Uniswap is USDC versus ETH. You can see traders pay 0.3% fees to the people adding their coins to the pool. So if you want to do that, you can earn those trading fees. The TVL is almost $500 million, and in the last 24 hours, $55 million worth of these coins have changed hands, and that 0.3% is getting paid out to people that provide liquidity. So we can add our liquidity here and earn trading fees. What is the difference between Binance and Uniswap then? They both centralize liquidity, but the key difference is Binance takes all of the fees, and on Uniswap, anyone can provide assets. This is a centralized liquidity venue. However, I can add my assets and I get the fees rather than Binance taking everything. You can add your assets by clicking add liquidity right here, and you can take your coins and put them in the pool. You also keep complete ownership of your coins because you can take them out at any time, and you have the custody of the liquidity provider tokens and your own tokens through your wallet getting linked up. That's the key difference. So with Uniswap, they don't take your fees, but Binance do. They take all of your fees, but we can get the fees adding them into Uniswap. So how much can we actually earn from providing liquidity, and how does that work? Well, it's actually different depending on which coins that you use, which exchanges, and which liquidity pools, because obviously the more trade, the better. And so you want to go and find the best liquidity pools to do this. So let's have a look at what we can do here. Before we get into that, if you do want to know how I trade and add liquidity into pools and how I earn passive income on crypto, I have an entire section of this in my crypto course, so I will leave it in the description. You can really go from start to finish on how to think about searching for liquidity pools, how to add liquidity into them, the pools that I use, and then obviously there are private Discord groups where I share my portfolio and what I'm doing day by day. So you can come and see those if you want. I'll leave that linked in the description. But when we look at pools, what we need to do is go to the best venues. Each chain will have a decentralized exchange that is the top exchange with the most volume. So you want to use something like that. And then you can come over to the pool section. So this is Trader Joe on Avalanche. You can also look at PancakeSwap over on Binance Smart Chain, but they all do basically the same thing. So allow you to put your tokens in. You can see each liquidity pair right here, how much the liquidity is, how much the trade is, and then even the fees paid. So as we can come down, we can see $50,000 a day is getting paid to liquidity providers in this pool. That works out at about 17.5% yield. If you come down to a stable coin pair down here, just above my head, you can see 5% around, that you're getting paid. If you go over to PancakeSwap, you can see a similar thing right here. So the liquidity pool, USDT versus BNB, trading around 54 million, and the LP reward around 14%, which is great. If we come down to a stable coin pair, you're looking at a much lower rate, about 2.23%. So why are there different percentages? Well, that comes down to risk essentially, and the riskier an asset is, obviously the more you have to get rewarded for providing liquidity. And this also ties into something called impermanent loss, which I'll go through right now. It's pretty complex. I do go through that in my course if you want a more thorough overview of this, because it's really important when providing liquidity. But basically there are two different ways you can add liquidity. You can add liquidity with stable coins, and you can add liquidity with risk assets. Very different. So impermanent loss is when you add risk assets to a liquidity pool. You get this thing called impermanent loss right here, which is a change in the price from when you deposit the assets into the pool to when you take them out. If the ratio of them changes, which it probably will if they're risk assets, because the price will change as people trade, you will suffer this thing called impermanent loss, and that will take away from the profits that you make. Now, this is just something you have to deal with. It's not a massive deal dependent on the coin. But of course, the more risky, the more that they move, the more you will suffer impermanent loss. And so the higher yield you have to get from those trading fees. You will lose money when you withdraw the assets if the price changes. And you can see here, if the price is exactly the same when you put them in and when you take them out, no impermanent loss, you get zero. So obviously, if you have stable coins like US dollar versus US dollar, and you can do that because there are different versions of stable coins. You have USDC and USDT, both valued at $1, or we would hope so, then they will obviously be the same when you put them in and when you take them out, no impermanent loss. And so fees are going to be way lower because you're just taking less risk. If you put in two crazy small altcoins that can change dramatically, then you're going to suffer huge impermanent loss. And so you're going to have to be rewarded for this more. So when we're adding tokens into a pool, what you need to do is take the trading fees that you get as a percentage, minus that from the impermanent loss, and that is either your profit or potentially your loss. You can actually go and work this out. Now, the thing that we obviously don't know is how much the price of the tokens will change from when we put them in to when we take them out. That is unknown, and so that's obviously more risky. but you can come to an impermanent loss calculator and try and work that out. So for example, if you have token A and that comes in at $1 and token B, that was 10, right? So token B, it takes 10 of A to buy B. That's when you put them in, then the price changes over time. Token A actually gets a little bit more expensive, so it doubles in price, but token B gets crazy expensive. You know, there's something that happens and let's say it goes up to $200. You can see you'd actually lose 42.5% when you take your tokens out versus just holding them and not putting them in the pool. So that's not good. You would have to make at least 42.5% in the trading fees to actually make up for this impermanent loss. But if it only changes from 10 to say 12, you only make a 3% impermanent loss. And so you would think that you would actually make more in trading fees. So when we come to, a liquidity pool, what we're really looking for is assets that are very mature and won't change much, usually yield less, and assets that are very small and, risky assets that change a lot in price. For example, this one, you're going to see a huge yield, but the impermanent loss is probably going to be pretty big as well. Come and join the public Discord server if you want to know more about DeFi and liquidity pools. I'll pin that as a comment. If you want to get more pro, definitely check out the course. It has an entire section on DeFi and step-by-step guides on how to actually go ahead and earn passive income with crypto. Or if you want to know how to use the platforms I talked about in this video, I'll link those tutorials in the description for you. You can go and watch them on YouTube. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.